Ladies and gentlemen, good day and welcome to Q1 FY2024 earnings conference call of Macrotech Developers Limited, hosted by Antique Stock Broking. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Biplab Verma from Antique Stock Broking. Thank you, and over to you.
Thank you, Ashishri. Good afternoon, everyone, and welcome to the Q1 FY2024 earnings call of Macrotech Developers Limited, hosted by Antique Stock Broking. Today, we have with us the management of the company, represented by Mr. Abhishek Lodha, Managing Director and CEO, Mr. Sushil Kumar Modi, CFO, Mr. Pratik Bhattacharya, CEO, Western Suburbs and Thane, and Mr. Anand Kumar, Head IR. Without further ado, let me hand over the call to Mr. Lodha. Over to you, sir.
Good afternoon, everyone. Thank you for joining us on this earnings call. I hope all of you are doing well and keeping safe in the heavy rains that we've been having for the last few weeks. To start off, I think it's important to get context of where India is looking in terms of its overall visibility on economic growth and job creation, and then speak a little bit more in detail about how the company is taking advantage of the conditions on the ground, which continue to remain strong in terms of demand as well as availability of land for our growth. L&T, India's largest infrastructure company, recently called for India's decadal moment, highlighting the massive transformational journey of our country. This is well supported by prudent government policy and a capable central bank, both of which have combined it to shield the country from global volatility. Not for long have we seen upgrades in India's GDP growth rates by global multilateral agencies, and we continue to see strong momentum in economic activity. India, in all probability, has seen the peak of interest rates, and the Fed might have also seen its last hike yesterday, which further lends stability to monetary policy and may even provide tailwinds to our sector over the next 2 quarters. 2 events, one in progress and one over the next 1 year, however, warrant attention. As we all know, weather patterns have been erratic, and India is no different. Mumbai has seen a fortnight of continuous rains, and July recorded an all-time high amount of rainfall. The spatial distribution of rains is poor, and while the government will do everything it can to manage its impact, food prices can certainly disrupt economics of our nation for the short term. We also have a number of state elections and the all-important central elections over the next 12 months. And both of these events are bound to have massive impact on the economy and the sentiment of the country and the people at large. Notwithstanding these factors, the real estate sector continues to be in strong momentum as demand for high-quality housing continues to remain very strong. And due credit to all stakeholders of the sector who have transformed India's real estate sector into a big and, more importantly, stable driver of India's economic growth plan. As much as I read and understand about China, the property sector seems to be an Achilles heel for their economy, while in direct contrast, we can hope for the real estate sector to play a big role, probably the biggest sectoral role, to drive GDP growth in India over the next 10 to 15 years. Coming to the company, we have continued to witness very strong momentum in the markets that we operate in. And the fact that one of India's largest real estate companies has returned to Mumbai is a testimony of the strong demand environment that exists in Mumbai, which contributes almost 40% of the total sales in the top 7 Indian cities. As a company, we continue to remain confident of sustaining 20% growth in our residential pre-sales, which will be driven by the rising contribution of the real estate sector to India's GDP. This in turn is driven by the creation of new households capable of home ownership, a function of the young demographic profile and rising incomes. It is also due credit to our industry to be able to provide quality products without raising prices extraordinarily, which erode affordability to the home buyer. For us, as a company, there is always a little bit of toggle between growth, i.e. business development, and reducing our debt. And it is a function of the enormity of opportunities that we are seeing and capitalizing on without going overboard. Our new project addition is well ahead of our expectations too, and the pipeline continues to remain very strong. All the same, we will keep our debt under control through the year and stick to our guidance of debt below 0.5 times equity and below 1 times of operating cash, whichever of the two is lower, by the end of this fiscal year. There is also not much we need to read into the fall in reported numbers on revenues and profits, as it is completely dependent on the OCs received in this quarter, and which is why the change in accounting policy that we are embarking on, which Sushil will get into detail later in the call. On the residential side, we continue to remain optimistic on the market that we operate in, and the business in Bangalore is also beginning to steadily take shape, with a launch expected in the next quarter. This launch has been delayed. We were expecting to have this launch in the current quarter, but be as it may, we are getting to there slowly but surely. The two large townships that we have in our portfolio are also an area of optimism, driven by improving infrastructure and continued product innovation. And finally, we are also gradually building our annuity portfolio in all three parts, i.e. warehousing and industrial, facilities management, and a selective portfolio of offices and retail, in order to ensure that we can have the steady annuity income with high teens ROEs to complement the scale up of our development business. A word on adopting our new move from the project completion based revenue recognition to percentage completion basis. And while it might create some transition challenges, we will be able to demonstrate a true picture of our performance and P&L, like the pro forma P&L we have been sharing, and in the next couple of years, which should stabilize. Sushil will explain this in detail, and we are happy to share further information with analysts in the days to come to understand how this transition will help provide much stronger clarity and visibility on the underlying business performance. Speaking a little bit more about the demand conditions on the ground, as we have been stating for some years, we are probably in the third year of a 15-year cycle. Our enablers of demand are measured by customer walk-ins and conversion rates, both of which remain robust. For the quarter, our walk-ins have remained at around 30,000, in spite of the fact that this is a seasonally weak quarter, and with very limited new launches. And our conversion ratio continues to remain above 8% in this quarter too. In terms of pricing, we have seen price growth of about 1% on a YTD basis for the quarter, which is in line with our goal of delivering price growth at about 6 to 7% for the year, which will ensure that we have a situation where pricing growth is below wage growth for the median home buyer, and therefore affordability keeps getting better. This, of course, is on the back of price growth of about 7 to 8% that we had last year. Further, on the construction cost side, inflation has continued to moderate. In line with our expectations, commodity costs have continued to trend down overall. And we have now seen that the annualized inflation from March 21 to June 23 has actually gone down to an annualized rate of about 5% or even slightly lower. In fact, the nature of construction cost inflation in India is one of the key differentiating factors of the Indian housing story vis-a-vis other economies. More than a third of the construction cost is labor cost, which is not prone to high levels of inflation because of the availability of surplus farm labor and the big difference in wages between at the farm versus at the construction site. Additionally, this ample and hardworking labor force is available to the entire supply chain of companies which supply to our sector, and thus the only inflation that the construction cost witnesses is of commodity inflation. Given how global economies are shaping up and the excess capacity in the construction sector, as well as the focus globally on inflation being brought down, barring any geopolitical issues, we believe that the construction cost inflation will remain quite contained in the years, in the quarters to come. Coming to interest rates, you can clearly see the shift in trajectory. The RBI did not raise policy rates in the previous two policy meetings. With inflation now starting to be within the target range of the RBI and other central banks now approaching the end of their rate cycle, it is likely that this pause will remain for an extended period of time, and we can start seeing some reduction in rates in the next 3 to 4 quarters. This stance from the RBI, coupled with the intense competition amongst the lenders, means that there is ample availability of mortgages, as well as these mortgages are available at competitive rates. Coming to some of the operational highlights of the quarter, we achieved our best ever quarterly pre-sales in Q1 of about 3,353 crores, which is a 17% year-on-year growth. Within this, our core residential business, i.e. excluding the sale of land to third parties, grew at a much stronger pace of almost 30%. What is heartening is that we have been able to achieve this growth while there were no significant launches at any new locations in this quarter. With launches planned at multiple new locations, including in Bangalore, which I mentioned earlier, from here on, we are fairly confident about achieving the sales guidance that we have given at the start of the fiscal. Our pre-sales are coming from 30 operating projects, showcasing the granular and diversified nature of our pre-sales. Typically, each project is providing about 100 crores of pre-sales every quarter, and this kind of diversification we believe is unique in Indian real estate and gives a lot more resilience to our sales and business. The embedded EBITDA margin for the quarter stands at about 30% of our pre-sales. This level of embedded EBITDA margin was achieved with nearly 35% of the pre-sales being contributed by the JDA projects. Over the slightly longer horizon, as we benefit from price increases, we should continue to deliver 30% EBITDA margin for the current fiscal, and we then expect that EBITDA margins will start rising from fiscal 26 onwards. Of course, this optimized mix of JDAs, which we are now approaching our target goal of 40% of our sales coming from JDAs and 60% from owned land, means that our ROEs are on an upward trajectory, and we expect to be approaching our goal of 20% ROE by the end of the current fiscal and in the next year. On the basis of the embedded EBITDA of 30% for the pre-sales of Q1 FY24, our PAT for the quarter should be well over 580 crores, implying a PAT margin of approximately 17% for the sales done this quarter. We remain confident of delivering the pre-sales guidance of 14,500 crores with an embedded EBITDA of about 4,300 crores and a pro forma PAT of about 2,600 crores. This, we believe, is a true reflection of our business and its profitability, and as I mentioned earlier, puts us on track to achieving an ROE of close to 20%. Our collections for the quarter were at about 2,400 crores. This should be seen in the context of the fact that our collections usually lag our pre-sales on a cyclical basis by 3 to 4 quarters, and we expect collections to grow in the coming few months, and therefore, with a more moderate level of quarterly business development addition, we expect meaningful reduction in debt in the second half of the year and bringing our debt levels between to the guidance that we have specified, once again reiterating 0.5 times of debt or 1x of operating cash flow, whichever is greater. In terms of business development, we added 5 new projects of approximately 7 million square feet with a GDV of 12,000 crores across various micro markets. These include projects in the western suburbs of Mumbai, as well as a new macro market of Alibag, as well as in Bangalore. Being able to enter the super prime location of Alibag means that we now have a large presence in what is the equivalent of the Hamptons for Mumbai. This market is not only attractive and has great desirability, but also is starved of any tier 1 supply. And we believe will, over time, become not only a second home destination, but also a first home destination because of its improving connectivity, as well as its very, very prestigious connotation. We have also informed that Lodha has been declared as the winning bidder for the marquee beach-facing land parcel situated at Juhu in western suburbs, which is owned by V Hotels Limited. We intend to do a very marquee residential development at this location once the scheme is approved by the concerned authorities. This will be again the planting of the Lodha flag in the important Juhu micro market and we hope will become another landmark development for the brand. As noted earlier, we remain confident given the strong start of exceeding the business development guidance that we've given for the year. Our net debt increased by about 190 crores to 7,264 crores, primarily on account of the front-loaded business development investment. This marginal increase is on a significantly enlarged base of sales and business development, and as mentioned earlier, we remain on track to achieve our guidance. We are also pleased to note the continuing improvement in our balance sheet has led to further credit rating upgrade by ICRA to A+ positive and India ratings to A+ stable. Our average cost of funds has declined in spite of the increasing interest rate environment by about 15 basis points in this quarter, down to about 9.65% now. On the ESG front, it is heartening to note that Lodha's efforts on sustainability are being increasingly recognized by various global benchmarks. After receiving exceptional scores from S&P Global, GRESB, and Morningstar Sustainalytics during previous quarters, Lodha has now been included in the FTSE for Good Index in the latest review in June 2023. We have recently published our second integrated report, and some of the recent achievements and highlights of the report include 90% renewable energy share in construction activity and standing assets. We are on track to advance our net zero emission goal on Scope 1 and Scope 2 from 2027 to the end of the current year, 2024. We are committed to achieving. We have also committed to achieving carbon neutrality in Scope 3 by 2050, with a short-term target of achieving at least 50% reduction by 2030. We have, in this context, submitted the science-based targets for verification to SBTi. We secured green certification for almost 20 million square feet in fiscal 23. And in terms of our social focus, our goal of building a stronger nation is being serviced well through the launch of the Lodha Genius program in partnership with Ashoka University, and our Lodha Unnati program for empowering women continues to gather momentum. In conclusion, let me reiterate our view that sustained job creation on the back of rising economic prowess of the country will create more than 100 million home ownership capable households over the next 10 years, whereas supply is expected to be less than 10 million households. This indeed can be India's decade, and housing will play a pivotal role in India's transition to a mid-income country. We remain excited about the future opportunities, and we remain committed to capitalizing on these opportunities in a disciplined manner. We are thankful to the investor community who have started recognizing the merits of Macrotech as a company which is providing stable, consistent, and predictable growth in a sector which is a necessity. And with this, we believe that the company is well poised to continue to deliver on our guidance and commitments and create value for all concerned. I will pause now and invite the CEO for our Western Suburbs and Thane markets, Prateek Bhattacharya, to share his perspective on those micro markets. Over to you, Prateek.
Thank you. Good afternoon, everyone. The western suburbs of Mumbai are well known for their lifestyle attractiveness and the presence of bustling hubs of business. For instance, media and entertainment. We know it as the base for Bollywood. Finance. We know about the Bandra Kurla complex that houses India's largest stock exchange by market cap, now NSE, as well as the Diamond Bourse. It's also a very big hub for aviation. It houses the city's airport and a lot of MRO industries. It's also a place which has a lot of IT, ITES, and many other forms of businesses. So in general, it's quite a bustling and cosmopolitan part of the city. And from a residential real estate perspective, it actually hosts all segments of consumers. Western suburbs, the primary market size is estimated to be between 25 to 30,000 crores annually, and it offers a full spectrum of possibilities. So it houses everything from sea-touching villas and super luxury condos, in places like Bandra and Juhu, to mass housing projects in Mira Road and everything in between. Talking about our growth, our market share in western suburbs, it has grown from being less than 1% 3 years ago to about 5 to 6% now, and we maintain our long-term goal to keep growing it towards our natural market share of around 20%. If we look at western suburbs a little bit more deeply, there are 10 plus distinct micro market clusters within it, and we are pursuing kind of a supermart strategy so that we can have a presence in most of these, and in a way that we have an array of non-competing projects in every 2 to 4 kilometers radius. Given our goals, our business development process is quite active. You just heard about it from our managing director just a little bit earlier. And in addition to one new launch that is planned in the upcoming festive season, we have a very active pipeline of projects that we are evaluating in all the micro market clusters within western suburbs. And we are planning the business development, in a way that every project that we bring on board, it allows us to do, an annualized pre-sales run rate of approximately 500 crores basis the current prevailing, price PSF levels. Now, from an execution standpoint, what we are doing is we are deploying into western suburbs the full toolkit of our experience from Thane. That's another market that I oversee, where we have built and consistently maintained a very high value share despite a high competitive intensity and, at least for the last 2 decades now. So in Thane, we have delivered 3 world-class townships, and our Kolshet Road project is a very good example of how we've created a thriving community of nearly 10,000 families in less than a decade. It's a place where residents stay in all kinds of segments of homes that span luxury to mass housing. They enjoy a vibrant high street retail, and they can walk to work in an office district with both large format and small size offices. Talking about the organization structure, we have a completely decentralized organization for western suburbs and Thane, and between these we have about 1,000 plus associates who are working in various areas like sales, design, construction and property management. So let me stop here and hand it over.
Hi. Thanks Pratik, for giving this phenomenal clarity around the potential that lies ahead of all of us when it comes to the micro market of Thane and western suburbs. Needless to say, this phenomenal market and potentially a lot many more goals and milestones to achieve for all of us. Coming to just giving some bit of a clarity around how potentially you should be seeing our revenue going forward, considering the fact that we are going to have our revenue recognition happening in tandem both under the POCM, which is percentage of completion method, as well as the PCM, that is the project completion method. The way it will work, obviously this has gone through the various accounting literatures and a whole lot of deliberation with the auditors and their confirmation, is that whatever contracts that we enter from 1st of April this year onwards, those are the contracts which will qualify for all of our projects to be revenue, where the revenue can be recognized or would be recognized under the POCM method. All the contracts that were entered up till 31st March will continue to be following the old method of revenue recognition, which is PCM, the project completion method. Needless to say, all of these becomes then pro rata basis the area. So that in that sense, that brings the simplicity to the whole of the dynamics, that the area pro rata is what decides the revenue recognition and thereby the corresponding back-to-back cost attached to it. So I think broadly that's it is. The whole crux is that this is how potentially the whole dilemma that was there for all of us in terms of understanding the company, its performance, while the performance, underlying operating performance was being, as you know, this year potentially, as the guided number itself speaks, 14,500 odd crores, and our last year audited financial performance was showing the revenue recognition more in the handle of somewhere around 10,000 crores below. So this is where, this dilemma that everybody was facing, and so is our board was also continuously facing this dilemma that your financial performance doesn't depict the operational performance, and which is where the necessity to revisit and kind of drill down, think through, deliberate with various stalwart and come to a conclusion. So we hope with this equation, as the projects that were there up till March 23 gets consummated, which obviously, as you know, typical gestation period for the projects is anywhere between 3 to 4 years. So as they all get completed, potentially by FY26, we would start seeing kind of entirety of our revenue coming under the POCM method. But till then, we will be living with both the method of revenue recognition. What it will do thereby is that the gap between our operating performance in terms of the pre-sales versus the revenue that is getting recognized or was getting recognized will continue to now get, as the gap will continue to see narrowing characteristic quarter after quarter and potentially year after year. And come FY26, we feel reasonably confident that as the old projects will get completed, so that means we would be broadly start tracking our operating performance in terms of our financial performance too. So that is it from my side. I think perhaps, we'll be more than happy to take as many questions or as many clarification that you would need, to understand potentially how some of these will work. Not that it has any rocket science, but nonetheless, if any questions, feel free. We will be, able to give you enough clarity and sense, be it on this call or maybe separately we can discuss along with our colleagues Anand and Chintan, and give you the clarity. So with that, perhaps we can get into the Q&A and would be pleased to give, answer all of your queries that potentially you would have to understand the company and the business far better. Thank you.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. We have a first question from the line of Kunal Tayal from Bank of America. Please go ahead.
Great, thank you. Sushil, I'll pose my first question on the accounting bit. So as you transition over to this new one, has it required any changes to either your collection philosophy or contracting or any other kind of structuring in either the sales agreement or any other parts of the business?
No, from a hardcore substance standpoint, business remain as is, no difference. Obviously, and perhaps Kunal may not be worthwhile to get into the technicalities of it, but just from understanding from a business standpoint, be it cash flow, be it sales, be it construction, everything remains as it is.
Got that. Abhishek, on pricing, appreciate the philosophy of keeping it below the wage levels. Just wondering if, as India sooner than later gets into a rate cut cycle, would the philosophy then be updated to look at the wage increase as well as the reduction in ownership costs from a reducing rate cycle as well, or you want to focus squarely on the wage growth part of it?
That's That's a important and pertinent point that you bring in. we believe that the rate cycles tend to be, I would say A, unpredictable, and B, there is a cyclicality to them. Whereas home price growth, they function best for the market when they are going, in a uniform direction of moving up, ideally at a gradual pace. If one starts baking in the interest rate cycles into the equation, then I think the level of cyclicality in pricing will be higher. And therefore, while we will examine this further, our general view is to stick to the wage linkage rather than have too much linkage to the interest rate dynamic.
Understood. Thank you.
Thank you. A reminder to participants to press star and 1 to ask a question. We have our next question from the line of Pritesh Sheth from Motilal Oswal. Please go ahead.
Yeah, hi. Thanks for taking my question. Firstly, is on your market-wide sales that you disclose. So if I see your existing markets, South Central Mumbai, Thane, Eastern Extended Suburb, have remained at a similar range since quite some time, maybe last 4-5 quarters, and so has been the industry trend as well in terms of the absorption of unit that is there. Right, while your large part of growth has come from the newer markets, and you are doing exceedingly well on that. When should we start seeing growth in existing markets or industry in general? What would be the trigger point? Since now, obviously, interest rate has also peaked out. What should be the trigger point that you think and will lead to growth for the industry that you have been talking about? Yeah, that's my first question.
So, if I understand the question correctly, you're probably asking us to break down how we look at our sales growth mix. We look at our sales growth mix in 3 parts. We look at price growth coming in at 6 to 7%. We look at volume growth in existing projects contributing about 3 to 4%. And then we look at new projects, whether and these new projects could be in any market. It could be a completely new market, or it could be new projects in an existing market, but it's a new project contributing about 10%. So overall, our you can compare that to a supermarket business where you have existing store sales of about 10%, like I said, 6 to 7% price, 3 to 4% volume, and new store openings contributing an additional 10%. So that's how we look at our 20% growth. In terms of there being any trigger point per se about when existing markets start contributing to sales, we believe that there has been good growth in all our markets. If I was to take our extended Eastern Suburb market, we've grown from 16 billion to 22 billion last year, and we are first quarter did about 6 billion, which again puts us on trajectory, given that it's Q1 is and Q2 tend to be weaker parts of the year. We are quite confident about delivering upwards of 25 billion between in our extended Eastern Suburbs in this quarter itself. For this fiscal. So we don't really see that the growth is only coming from new projects or new locations, but it is coming from a mix of price growth and modest volume growth at existing projects, as well as contributions from new locations.
Got it. So as and when new projects come up in the existing markets, we will see further growth in that markets as well.
Yes.
Yeah. Okay. Got it. And second question on the land investments that we had in this quarter, around 800 crores. If you can help me reconcile how much was that for the projects that you have signed this quarter, and how much of that was for projects which we had earlier. I just wanted to understand what's the quantum of investment that was needed for this 12,000 crore of acquisition this quarter.
So in terms of that investment, generally we've done a deep reconciliation, and we are finding that the level of investment in our JDAs is running at about 5% of the GDV. which is at the lower end of the range that we've spoken about earlier of the investment levels being between 5 to 10% of the GDP. This quarter's spend includes about 700 crores, just under 700 crores of spend on new projects. Some of those are part of this 12,000 crores, but there are also projects where particularly we have made investment of about in terms of future projects where the signing process is still being completed, and that's not included in our 12,000 crores. So if to your question, I think if you would look at that 5 to 10% range that we guide as a total peak investment on joint development projects, that would be the right number to look at. And in terms of this quarter's mix, just under 700 crores has gone towards new projects, which is the 12,000 crores that we mentioned, but also investment in some projects which will be announced in the upcoming quarters, including the V Hotels investment.
Sure. That's very helpful. And none of the projects that we acquired this quarter was outright land, right? I mean, Alibag 10,000 crore is all JDA, that I understand, but rest of the two, probably Bangalore also, I assume it will be JDA, but Western Suburbs is outright or again a JDA?
This quarter's acquisitions have largely been JDA, and I think we continue to remain focused on growing significantly through the JDA model. There will be, outright investments from time to time, but largely focused on JDA.
Sure, got it. And just one last, if I may, on Alibag, big project, 10,000 crore revenue potential, 6 million square feet, sellable potential. What are our plans, and what is the monetization timeline that we are targeting for that, considering it's a large project? And
so I would like to correct that it's a project. It's a large land parcel comprising of multiple projects. We will be developing, the project in for various different segments with different product mix in that location, and therefore, we will be having different multiple projects in that large land parcel, which we've been able to acquire, which is an irreplaceable land parcel in our view, given the land scarcity in that location. In terms of, we expect to launch that as we typically do for any new project in about 3 to 4 quarters from its acquisition. So we probably look at a launch sometime in early to mid of the next fiscal. In terms of, as I mentioned, we're looking at targeting both the second home and the first home market, and then things which are ancillary to that, which would come with some amount of retail and so on. So we expect this to be a long-term contributor of sales to the business and provide, I would say, critical, addition in terms of a new market. Also gives us more entry into the second home market, which other than Lodha Belmondo, we don't have exposure to right now, and allows us to have access to an audience which is keen to get high quality product, which is currently missing from a brand, a grade A brand in that location.
Sure, got it. That's it from my side. All the best.
Thank you.
Thank you. Ladies and gentlemen, in order to ensure that the management is able to answer queries from all participants, please restrict your questions to 2 at a time. You may join back the queue for follow-up questions. We'll take our next question from the line of Mohit Agrawal from IIFL. Please go ahead.
Yeah, thanks. My first question is on the Bangalore market. So you've been now there for a few quarters. If you could share your experience, how is it different from the Mumbai market, especially on business development, considering you are in a ramp-up phase? And if there are any challenges that you're facing in terms of execution or business development?
As we've stated and articulated in the past, whenever we enter a new city, we spend the first few years being in what we call pilot phase. During this period, our focus is building up organization capability and delivering projects, which we believe is the best way of strengthening and creating a brand. So in Bangalore, this is exactly where we are. We are in pilot phase. We acquired our first project last year, which will be launching in the upcoming quarter. We've just acquired our second project, which we also expect to launch in the current fiscal. We expect in this pilot phase, which will last till the middle of the decade, i.e. up to FY2025-24, that we will focus only on a handful of projects. So it's not that we are going to go into Bangalore and suddenly make a huge investment or try to do 10 projects. It's going to be a handful of projects, 3, 4, 5 projects. Focus on delivery and only then ramp up once we've delivered our first project. In terms of our experience on the ground so far in Bangalore, we have been positively surprised on the pricing growth that we are seeing over the next 12 months, and which would help us get profitability which is higher than our initial expectations. We've also, as we had expected, are learning the curve when it comes to the ground realities of operating there, looking at the construction ecosystem, understanding the approvals process, and that has been, all things which have been along expected lines, taking the time that they deserve to be taking. We have been able to build a strong team, attract talent from a number of the good companies operating in the Bangalore market. And I think that's been a good upside to us, that we have now started getting access to a well-trained talent pool in Bangalore, which will, in our opinion, give us good sustainability of the business in the years to come.
Okay, understood. My second question is for Sushil. On the POCM revenue recognition, when does the revenue recognition start? So does it start immediately as the construction commences or the project is launched, or will you wait for 25% kind of a threshold which was there earlier as per the CA Institute guidance?
No, you're right. So obviously it doesn't start right away. It will have few thresholds, not just construction, but there will be few thresholds that will be met, which includes an agreement need to be in place, the collections would have started, the construction, some bit of a construction threshold has been met. So it will be a combination of few, and once that is being satisfied, that is where it will kick in, and which is why perhaps, as you would see, while we have taken it for all the contracts starting 1st April, but it has not contributed anything significantly in this quarter. It will only perhaps start showing the result starting from the second quarter.
Okay, just to understand this better, is there a number, and will that include the land cost as well, or this is purely like a percentage of the construction cost thing?
No, the threshold that will be there, the gatekeeper equation that will play for a project or for a sale to qualify will be a construction cost oriented. And obviously, as I said, the other parameters including collections and all.
Okay, understood. Those were my questions. Thanks.
Thank you. We have our next question from the line of Abhinav Sinha from Jefferies. Please go ahead. We've lost his connection. I'll move on to the next question from the line of Puneet from HSBC. Please go ahead.
Thanks for the opportunity. Can you talk about how different would your profitability from a city like Bangalore versus what you do in Mumbai?
Hi. We expect both in Bangalore as well as in Pune for our margins to be about 200 basis points lower compared to like-to-like segments in Mumbai. Mumbai's profitability on a PBT basis is likely to be about 200 basis points higher than Bangalore or Pune.
So if we assume 30% from Mumbai, then 28%, that's the only gap you see, despite different realizations.
I was expecting more on a PAT basis, but you can approximate it at the similar level for EBITDA also.
Okay. So despite different realizations, not much of a difference in some sense.
No, I don't think that it's, I think it's important to understand our mix in Mumbai. Our average sales price in Mumbai is about 10,500 rupees square feet on saleable, or approximately 16,000 rupees on carpet area. So it's not that we are having a realizations which are dramatically higher in Mumbai. We have a wide presence in Mumbai. We sell homes which are, selling at 6,000 rupees a square feet on saleable. Of course, we have homes selling at much higher prices too. But we are a company which has had good exposure in operating in the mid-income segment. And therefore, I think, the ability to operate profitability in Bangalore or Pune is very different for us, because we know how to operate at these cost price points, both from a consumer perspective as well as from a construction and land cost perspective.
Understood. Thank you. This is very useful. And secondly, can you also talk a bit about, getting back into annuity business versus development business? Because again, those two businesses have different return expectations. As a developer, how do you, marry into a development business as well as focusing on pure, so-called low-margin annuity business?
I think it's a great question. I think the objective that we have is to have growing but reasonably high ROE annuity income stream, and we are targeting on a blended basis a mid to high teens ROE level on our investments on the annuity business, which is not far from the 20% that we are overall seeking for the business. So we are quite mindful of the fact that while we build an annuity portfolio, it should not be ROE dilutive. We are using 3 different strategies which help us achieve this objective. One is our facilities management business, which is an adjunct to our development business. Being very low capex, the ROE levels in this business are quite high. Margins are at about 10%. The second strategy we've taken is in the warehousing and industrial business, what we call digital infrastructure, where we have a 1/3 equity stake as an LP in the platform, but we are also managing the platform and therefore earning fee income from our the overall platform. At the asset level, we make ROEs which are in the sort of mid-teens, but we are able to add about 200 to 300 basis points to that ROE on account of the fee income that we make from the platform, and therefore we get to kind of somewhere in the higher teens on that. Lastly, on the office and retail, we are very, very selective here. We will typically build and lease these assets and then sell them, because we believe at that point in time the ROEs move to a trajectory which are not commensurate with our overall goals on ROE. However, there are select locations where the price growth or rental growth is expected to be much higher than what the market is underwriting currently, either on account of the quality of the product or the location being very difficult to bring new supply into. And those are the only assets that on the office or retail side that we intend to retain. We expect to have about net income of about 500 crores from our annuity portfolio by fiscal 26 and grow that to about 1500 crores by fiscal 31. But in doing so, ensuring that we maintain mid-teen ROE on the annuity part of our investments.
So would the understanding be right when you said, lease and sell versus own it? You might actually own those locations which are weakly priced now, but you expect pricing appreciation, but you might be selling the marquee assets which are already fairly priced. Is that how one should read it?
I would put it in a slightly different way. We would sell an asset when we believe that the pricing growth ahead is reflected in the exit values which are available today. So we are not, we are not driven to hold on to any asset forever on the office and retail side. Let me put it that way. We are happy to hold it for a longer period of time, which could be as you mentioned, potentially locations which are re-rating, but it could also be, a highly rated location where the rental resets in the subsequent cycle are likely to be much higher than what the market typically underwrites. Typically, these assets are underwritten a 4 to 5% price growth. But if we expect higher price growth than that on the rental side, we might hold on to even a marquee asset for some time.
Understood. This is very, very clear. Thank you so much. Lastly, if I may, what is the specific change in the contract that you have done that has allowed you to move from PCM to POCM method?
See, 2 things have to be... Sushil, I'll just add and then Sushil will, of course, add to that. I think 2 things have to be taken into account. One, that the empirical evidence suggests that once the agreement is entered into, there is almost no cancellation after that. And I think that is itself the core of the shift from in the methodology. In addition to that, we have made some specific changes allowing the enforcement of specific performance on these agreements, which allows us to transition as per the Ind AS guidance, and this change has been made in the last quarter only. But Sushil will further add to that.
So I think broadly, Abhishek, you covered some of the important parameters. Nonetheless, there are a few more that has happened, but the crux perhaps lies around the enforceability, and which is what Abhishek covered. So yes, a number of changes, but some of the important ones, in any case, Abhishek highlighted.
But there was still something which couldn't let you, change your earlier PCM into POCM, right? That is something specific which has been added now.
Yes, if the contract is status quo, then obviously we could not add. So the contract that has already been entered, I know. Obviously, we perhaps would have the possibility if we can get those contracts amended, which is another era, and that maybe we can look at it or we can think over it. But as is situation, the old contract, yes, we could not have.
Understood. That's it. So thank you so much. All the best.
Thank you. We have our next question from the line of Abhinav Sinha from Jefferies. Please go ahead.
Hey, hi. Thanks for taking my question. Sushil sir, just following up. So, in Bangalore, will we follow POCM or that's under a separate RERA and can't be done?
No. In Bangalore too, we will be following the same POCM.
Okay, so technically this can be done across India, right?
We hope so. This is by now the kind of PhD perhaps we have achieved. Analyzing, reading lot many literatures, consulting, discussing with lot many stalwarts, be it in the field of accounting, be it in the field of legal fraternity. So we think prima facie, yes, perhaps it is what you said is right.
Thank you. And Abhishek, a couple of questions for you. One on the Centaur acquisition. What are the next steps we should watch out for here? And does the substantial sort of outgo which happens here, is it factored in the guidance of gearing for the year?
Abhinav, hi. Yes, in terms of the scheme has been put up for approval to the concerned authorities. It will be finalized by NCLT. Time frame of obviously being a judicial process is difficult to comment on, but we expect it to happen in the next either this quarter or next quarter. Obviously, that's only our estimate. It's not a firm guidance that it will happen in this time period. As I said, it's a judicial authority which has to decide. And yes, we have taken all investments that we have committed to into account when we have reiterated our guidance on achieving our debt trajectory of being below 0.5 times equity and below 1x of operating cash flow by the end of this fiscal.
Great. And lastly, you've also highlighted several large infra improvements happening near term around Palava and Upper Thane. Now, I understand you don't want to, take aggressive price hikes on the residential side, although, one can argue for that now. But on digital infra, can there be like a reset there as the infra improves quite substantially in the near term?
I think probably, I would like to differentiate between our digital infrastructure initiative, which is a pan-India play on industrial and warehousing in partnership with two global investors of great repute, Bain Capital and Ivanhoe Cambridge, versus our monetization of our surplus or excess land, which is happening in Palava and Upper Thane, where we have large land holdings. In terms of our land holdings in Palava and Upper Thane, I think the infrastructure which is completing over the next 12 months will give a substantial re-rating to the location. Connectivity will dramatically improve, and then as other larger things, including the Mumbai-Nasik leg of the Mumbai-Nagpur superhighway and the airport in Navi Mumbai become operational sometime in the next, I would say, in the 12 to 24 month time frame. That will be an even further boost. In terms of land valuations for sale to third parties for any use, it could be for warehousing, it could be for industrial parks, it could be for data centers. We do expect re-rating of these locations. We have also started seeing now that we are getting multiple players getting interested in getting data centers to our Palava location, which meets all the technical parameters, and with land in Navi Mumbai now slowly getting exhausted, Palava is starting to attract that interest. Nothing has been crystallized yet, but when it happens, that will also be another trigger of a further upward rating in the land values, because if you have multiple industries or asset classes wanting the same land, plus the data center land valuations tend to be much higher. Thane, they have bought land at about 20 crore rupees an acre. We do expect an upward move in the land valuations, I would say sometime in fiscal 24. Sorry, fiscal 25.
Great. Thanks and all the best.
Thank you. We have our next question from the line of Parikshit Kanpal from HDFC Securities. Please go ahead.
Hi, Abhishek. Congratulations on a great quarter. My question is on this issue of Mother Earth and the RG on Mother Earth podium level. So what's your view on that, and can it derail our launches for the second half?
Sorry, your voice is not very clear.
Mr. Kanpal, please use your handset.
Hello. Is it better now?
Yes.
Hello. So this issue of RG on Mother Earth or the podium level, so what is your view there? Because the matter is, I think, in Supreme Court. So can it derail the launch momentum for the second half? So what approach you are taking there?
Hi. Our approach to regulatory matters is always the same, of accepting whatever the regulatory environment is and moving forward. The rulings in case of the land on Mother Earth RG are very clear, and in all our prior launches as well as the current ones, we are in compliance with that. So we do not expect any meaningful impact on our launch strategy, or for that matter our project progress on account of this regulatory change.
But sir, any of our projects were on the podium level, which were in the launch pipeline and which may undergo a change?
No, I think the reality is that not that we have any idea of these regulatory changes which may happen, but we in general, given our commitment to environmentally sustainable development, like to preserve as much of Mother Earth as we can, and not have significant not excavate out the whole site, and keep the Mother Earth which enables the planting of a much longer lasting variety of plantation. So because of our focus on sustainable development, this has not been an issue for us, because that's already been part of our design and planning requirements for quite some time.
My second question is on the Centaur. So this GDV which you have disclosed about 12,000 crores, so does it include the Centaur GDV, and what will be potentially the GDV from Centaur then?
No, it does not include the GDV from the potential acquisition of V Hotels. We only account GDV once we sign the definitive documents for an asset. So obviously, as you know, the V Hotels has not yet been signed up. So not something that we account for at this stage. We will only update once the definitive documents have been put into place. We will update on the likely GDV. What I can tell you is that the development will have about upwards of 7 lakh square feet of carpet area.
Wow. Great. Thank you, sir. Those are my questions, and all the best.
Thank you. As there are no further questions, I would now like to hand the conference over to management for closing comments. Over to you.
Thank you, everyone. In conclusion, I would say that demand conditions remain very strong, as Abhishek mentioned, with a very strong consumer demand, desire to own a home. And in our view, this is just a reiteration of our view that this is just the third year of the 15-year long residential cycle that we have just started. So there is a long runway of growth that we would see. Please feel free to reach out to me on either the operations or financial performance. Thank you, everyone. Thank you.
Thank you. On behalf of Antique Stock Broking, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.
Please subscribe and press the bell icon to never miss another update. Please like,